It's a full 1% cut that we are seeing on the mid-cap index right now. The Nifty Bank is also seeing losses widen, so 130 points gone over there. There are a lot of the banks which have definitely come in for some selling right now. And like I was pointing out, it is only the Nifty metals pack in terms of sectoral indices which is managing to hold in the green. But heavy pressure seen in the mid-caps as well as small caps. We'll talk more about the markets with Jyotivardhan Jaipuria. He's founder and managing director at Valentis Advisors. Mr. Jaipuria, thanks a lot for joining us as always. This is Pavitra. If I can begin by just asking you about what we're seeing globally, with this entire collapse of SVB. I guess a good part is that the resolution has come through very quickly. But how much of an impact do you think that, we can see, even if it's in terms of, a tech-focused impact on our own markets?
Yeah, so Pavitra, the good thing was that over the weekend before our markets opened, they managed to do this. Otherwise, there would have been a lot of nervousness. I think the nervousness comes not just from tech and from some companies whose money was probably stuck and there was fear they may not be able to get it back in a hurry. The real fear was, is this a Lehman moment? Does this lead to a whole contagion effect in the banking system? So I think, that's the reason that, all the regulators in US stepped in, the Fed stepped in, FDIC stepped in, because they wanted to prevent another Lehman happening. And that they've ensured to do, because it was not just, one bank we were talking about, Signature Bank had come, and there probably would have been a spate of other banks if they had not backstopped this at the moment. So I think what this has ensured is, one is that, there's no contagion effect. So at least that part of the panic cools down. The second is what this does to the Fed rates now and the path of the Fed rate. Probably, there are already some people saying that they may skip a rate hike in March. The earlier debate was, is it going to be 25 or 50? And now, some people are questioning probably could be zero. I think my view is they probably will go ahead with their path of hiking, but they may do 25. It will just depend on the data which comes in. But in the end, the terminal rate may be a little lower than what would have thought before the event, because the Fed has now figured that as they keep hiking, is not just the rate increases that they are doing to tame inflation, but what it does to the bank balance sheet also. So I think, net the positive may be that the terminal rate hike may be slightly below what would have happened if this event had not happened.
Okay, Jyoti, great to have you on the show. The point here is that probably is the best case scenario, right? That the Fed just takes its foot off the pedal a little bit. But is it enough to enthuse the market? I mean, this market has had so much to deal with right from the start of this calendar year. Do you think the bulls will be able to rev up at all? Or do you see maybe a time correction play out for the next few months?
Yeah, so we see our whole theme has been that there will be a time correction. In fact, like I would say, market has been more resilient than what I thought. We were thinking there probably could be a correction some point early part of the year, which has not happened. Like the correction are very, very shallow and they're hardly they're bought into very quickly. So our view was that it's a market of 2 halves. For the first half, we'll probably see a negative return and the second half sees a positive return. So you end the year with a single digit sort of return. But we've had a time correction for 18 months now, and probably, we could have it for a few more months, which, may seem very painful to investors. But when you look at it in a relative sense, India has done very well. And I think, probably that's the best way to get, the high valuations under control. Because ultimately, we all know we were sitting on valuations which were very high. At some point, sentiment had become very euphoric. And these are things where, either you get a time correction or you get a price correction. I guess all of us would rather take a time correction than have a steep price correction there.
Jyoti, you've always been bullish in the small cap space, and last year your small cap focus helped you outperform. I think the stocks that you invested in helped you get a return of nearly 9%, even as the small cap index was down 15%. Does that continue, or considering the number of events which have altered the course of the market this year, Adani's and now possibly the collapse of financial institutions in the United States, does it alter your belief on the small cap index doing well? And which would be the small caps that you bet on currently?
Okay, so we were actually last year, we were a little negative on the small cap. So when we started 22, my view was that the small cap index would do badly relative to the large cap because, they were much more expensive. And, we were just coming off a very euphoric phase where the small caps had done very well. So this year, our thought is that as we move into the second half, the small cap index will do better than the large cap index because of three reasons. So one is, small caps have become relatively much cheaper. So they trade at like a 30% sort of valuation discount to the large caps. Second is they're done badly relatively. Like you said, last year the small cap index was down 15, the large cap index was up 5, and that trend is more or less flattish in this calendar year. Third is, if you look at earnings, then a lot of the small caps are actually commodity users rather than commodity producers, whether all the commodity producers are large caps. So last year they all gained because the commodity prices went up. The small caps got hurt because of the high commodity prices. That has reversed to some extent. So this year what we'll see is many of these small cap companies will see their margins increase and go back to, or at least try to go back to the level they were before the Ukraine war, because commodity prices are coming off. And so that again would help small caps. So I think, second half of this year, we'll actually have a better scenario for small caps. Last year, of course, we managed to do well in spite of the index not doing well because of some stock picks. But this year, I'm hoping we also have the tailwind of the index itself doing well.
Okay, like you were saying that we might get a time correction for a while. We might see this phase of consolidation for some time. Overall, how do you approach the market at a time like this? And considering that there are so many of these global risks that we were talking about, do you completely stay away from global facing stocks and look perhaps only at domestic growth?
Yeah, so that's been our theme for like 18 months now. We've generally been, mostly away from the global plays and just focusing on domestic plays where there's a little bit more of certainty. Even within the domestic plays, our call has been more buying investment-related plays rather than consumer-related plays, because especially the rural consumer is seeing a slowdown, and that, was something we wanted to avoid. So those are the two themes we've been playing with, and we just continue to be with that theme. So far, we've not made any move which is different.
So, Jyotivardhan, let's talk about IT, right? That's the hot sector right now. What has your view been, overall? And more importantly, in the here and now, how do you see this play out? There's recession, there are bank failures. We don't know to what extent the interlinkages play out. What would your approach be to the Indian listed universe, at least?
Yeah, so like in line with our theme that we were underweighting the global plays, we didn't have much of IT in our portfolio. We've generally been underweight IT. We continue to be underweight IT, not really made any big move there to buy them. So I understand that the stocks have fallen, they've underperformed, the valuations have become a little cheaper. But even now, I think, the outlook is quite cloudy because, you don't know how bad the US economy becomes. And to that extent, at the moment, we're still staying away from IT. It's getting a little more interesting for us because it's underperformed a lot. It's become, much cheaper than what it used to be 18 months ago. But even now, we think we are safer off buying the domestic players than trying to, call a bottom on the IT stocks.
How much upside do you see in domestic names? Because capital goods, infrastructure, they've all done well in the recent past.
Yeah, Rima, they've done well. So, from our point of view, we generally try and always think of like the small cap companies and where they'll be 3 years later. So typically, we're always trying to think, can we make a 20-25% compounded return in all these stocks, which then, gives us somewhere between 3 and 4 years, we should be able to double our money. So that's really our aim when we try and, look at every company, which we do. Ultimately, see, we have to buy like only 15-20 stocks. So for us, it is we don't have to buy every company under the sun, buy some things which are not in the radar of everybody today. So you have cheaper valuations and where you can get, some decent earnings growth, which is like 15 to 20% range.
All right, we got that. Mr. Jaipuria, as always, thank you very much for stopping by and speaking with us today. We're going to leave it at that. It is time for a short break on the show. The market continues to fall. It is now a near 50-point cut that we're seeing on the Nifty. So let's take a short break. But when we come back, we'll talk more about the markets in just a bit.